Hi, everyone. Welcome to the Timing Research Show for October 12th, 2015. Today we will be talking about the 107th weekly report from Timing Research. If you haven't had a chance to take a look at this yet, just go to TimingResearch.com/reports, and you can download it there. Dave Landry, who usually hosts for me, is taking a break for a couple of weeks, but we have Matt Buckley here taking over as host. So I'm going to go ahead and turn it over to him now.
Hey, thanks, David. Thanks, folks, for having me as a guest host. Dave's an awesome guy and deserving some well-deserved time off here. So, going to have a great session today. Got a lot of awesome answers that I looked through last night and this morning. Very, very interesting to see how you all think. And we're going to jump in all that stuff. Before we get airborne, though, today we're obviously going to go around and ask our kind of our trader roundtable to introduce themselves, who they are, their website, what they do, their background, all that type of stuff. So, Jason, if you can hear me, man, why don't you lead us off? And Jason's from the LionOnline.net, more or less the Lion of LaSalle Street. So, Jason, tell us a little bit about yourself and what you do.
Sure. Hi, guys. Thanks for having me this week. Just real briefly, what I've chosen to do is focus on the psychology behind markets and the psychology behind trading. And I tend to focus heavily on how people are thinking to reach their conclusions. I look at things like market sentiment and just generally ask questions about why people feel confident that the market's going to move higher or lower, or whatever it is that they're trading. And I find that understanding the psychology behind everything seems to make a huge difference when I go to do analysis, because the analysis that we tend to rely on is almost always all price-based. Mm-hmm. And that price didn't get there unless there was someone willing to buy or sell, someone was willing to take a loss, someone was willing to hold gains. All of that's the psychology behind what we do. And so I find that psychology really makes a huge difference. So my point of view today when we're discussing the markets is going to stem largely from what traders are thinking and how they might be behaving. And of course, I give a little bit more detail on my website. Of course, if you want to go, I'll have it. Actually, I have a new website that will be launched here within about 2 weeks with new details on it. So maybe TheLionOnline.com.
That's great, Jason. You bring up a great point. I mean, price action is mainly driven by how people are feeling. You would think it would be just data driven, but I like to say until the robots become self-aware and kill all of us, they're still programmed by us, and traders have emotions. So that's great. I'm looking forward to hearing what you're saying. Jim, sounds like you just jumped online, sir.
Yeah.
Jim's coming from the optionprofessor.com. Familiar with Jim and his good work over at Option Professor. Why don't you tell us a little bit about yourself, what you do, and your background?
Sure. Well, as far as what I do with Option Professor, I am only the content provider for them. So basically, they have DVDs that go over the uses and risks of options from the buy side and the sell side, where you're writing the options with not limited risk, and where you are buying the options with limited risk, and all the different strategies for creating cash flow as well as speculation. And of course, they've got 7 DVDs that I put together for them. And the main focus is making sure the guy out there trading has a universe of knowledge about the use and the risk of every tactic. And then before they go in there and take that risk, they know a good background, a good balanced presentation on how that can help or hurt you.
That's great, Jim. I'm familiar with a lot of your folks up there. I'm glad you used the word tactic, because a lot of people get that completely wrong. They say, hey, my favorite option strategy is covered calls or an iron condor, and that couldn't be further from the truth. So you're right, man. You nailed it. It definitely is an option tactic. Okay, great. Looking forward to hearing from you here in a little bit. And then finally, Corey from AfraidToTrade.com. Interesting name, and he's out there in God's country, out there in SoCal. So Corey, tell us a little bit about yourself and what you all do.
Thanks, Matt. Yeah, it's coming to you from Hollywood here in Los Angeles, California. Native of Alabama originally. I've been doing Afraid to Trade since 2007 professionally. When I became a full-time day trader, really beyond that, 1999, 2000 began my hobby, interest, and passion in the markets, and that's led to almost 15 years now later. What I do with Afraid to Trade is also combine psychology. That was the initial point of it, sharing my personal story about how to become trading, investing, how psychology plays in, how to overcome those emotions, both greed and fear. But I really became more of a trend trader, looking intraday in terms of tactics on retracements, breakouts, and reversals. And I share the strategies with the members of AfraidToTrade.com through weekly commentary, particularly on intermarket analysis, what the other markets, oil, crude oil, gold, silver, treasuries, currencies, all those, how they interplay, and a daily blog as well with intraday reports and sector rotation, stock strength, relative strength, looking at ETFs, and really motioning of money flow throughout sectors and leading stocks.
Awesome. Okay, we're looking forward to hearing all that stuff as well. I love everything that you're talking about there. It sounds like you and Jason might want to have a beer together. Let me talk about who I am real quick. My name's Matthew Buckley. My call sign is Wiz, and obviously I didn't. My parents did like me. That was my God-given name, Wiz. I earned that. I flew the F-18 Hornet for the United States Navy for about 15 years. Graduated from the Navy Fighter Weapons School, known as Top Gun. Hence, my marketing department is huge. That took about 15 minutes. And I flew 44 combat sorties over Iraq. Sounds like Corey and I have a little bit in common. I'm going on about 2 decades self-taught. I instead of sitting in the ready room in between flights, playing foosball or reading the newspaper, I was always interested in finance because kind of like combat, it's binary. Somebody's going to win on a trade and somebody's going to lose. And I started applying everything I was learning flying fighter aircraft, having a strategy, employing tactics, managing risk, not making emotional decisions, but making decisions based on data, and they had to be right, because at the end of the day, if it wasn't right, you weren't coming home. So applying that to my trading led to some pretty good things. I got picked up to be the managing director of strategy for Peak 6 Investments, one of the largest volatility arbitrage firms in the country, probably down the street there from Jason on Jackson and LaSalle. And I was also the founder and CEO of the Options News Network, ONN.TV, which was kind of the CNBC for options, because back in the day, 2007, 8, 9, CNBC was more or less just paying lip service to options. They had their token, John and Pete, buddies of mine from Chicago, but I started the Options News Network, and that was a blast. Had an absolute blast doing that. Right now, I'm down here in beautiful South Florida, where you guys can keep your Chicago winters, man. That ain't for me. Whoa, we're going back in time here, so let me stop my screen sharing here. So that's me. We're going to get airborne in a couple minutes, but I want to turn it back over to David, because if you looked at the report this week, he's got a pretty freaking cool indicator, the timing research crowd forecast indicator. I'm going to let him talk about it because he's going to explain it better than I can. But to be honest with you, I might be using this thing shortly to be placed in some trades. So David, back over to you, bro.
All right. Yeah. Thanks. Yeah. So if you've seen the report yet, you'll notice that I added a new feature last night, and this is something I've been talking about doing for a while now, but I have over 2 years of data from this project, and so basically I finally added a way to display what has happened, not only just overall through the history, but what has happened in previous weeks in conditions similar to this week. So so you can see on there that it says. I
don't know, David. It might just be me. I'm not seeing your screen. I want to make sure. Is everybody seeing David's screen? Might just be me.
Oh. Yeah, I can see it right there. This is Corey. I can see it.
Okay, cool.
Might be awesome. Just a glitch on your.
Got it. Yep.
Yours, but okay. So for this week, the overall sentiment is lower. Slightly more people pick lower on the survey, and but the higher average confidence is on the bullish side. So when that has occurred previously, the overall sentiment has only been correct 42% of the time. So I'm predicting, based on that historical data, that there's a 58% chance that the S&P 500 will go higher this week. So, and of course, I'll be refining this over time, and the report will fully explain each week the prediction based on the past data and why. So that's just a new feature as part of the newsletter.
That's great. I like that. Yeah, and like you and I talked about, David, I'm definitely a data guy, so that's pretty cool. I'm going to be taking a look at that going forward. All right, so let's get back to it. We'll just go top of the batting order all the way to the bottom. Jason, Jim, and Corey. Let's go to question 2 first. Based on technical, fundamental, psychological indicators you want to use, would you predict that the S&P 500 index will move higher or lower from our open this morning to Friday's close, so October 12th to October 16th? So Jason, you can lead us off.
Okay, you got me. I had me on mute before, so I just want to make sure we're on.
Loud and clear. You got it.
Okay. I'm looking at a very simple point of view this week. I think that the issue with the Fed recently not changing interest rates and people just highly expecting that, people are really discouraged, and I think they're in a wait-and-see mode. I notice things like volumes have been dropping a little bit lately. Participation seems to be kind of slowing down just a little bit. And here we are higher every single day for the month of October since the big slam in August and a sideways month in September. I think this is all random noise. I think what happened is that for right now, for the most part, traders are trying to decide if there's going to be a rate change or a change in the rate cycle process, and they're really just at the point of scratching their heads right now, and they're not really going to start committing a whole lot of money or a whole lot more confidence until they have that resolved one way or the other. You know, people were really, really heavily focused on a change in the policy from the Fed here at the last meeting, and when that didn't happen, I think it really just caused a lot of people to take a step back and say, where are we really headed here into the end of the year? And it's Q4. October is Q4 now officially. And there is a lot of reasons to bank what's out there. There's a lot of reasons to wait until after the first of the year to reallocate portfolios. Mm-hmm. And I think right now what we're looking at is we're at the top end of what could be considered range play or selling pressure from previously at this price point, a little up closer to that 17.5 area maybe. But I think for right in here, I think it's very reasonable to expect that we'll be lower by Friday's close from today. And the reason I would say that is basically I think the market's tired. I think it covered a little bit of ground here on low volume, and I think people are just really confused. They just don't really have the same confidence level that they had before. And I think they're trying to figure out what that means for the end of the year to keep what they have banked and be prepared for when there's eventually a change happening that could come at any time, but they don't know when. So I think there's a little bit of confusion right now. And confused markets and frustrated markets don't typically rise in value. So I think that what's happening right now, it's just a little bit of a dead cat bounce, and I think we're going to see more sideways to lower action for the rest of the week.
Okay, so Jason's in the lower category. What's your probability? Give us a percentage.
I usually don't do anything unless I'm like 90 to 95% confident. Usually, okay. But I got to tell you, this one has got me a little verklempt. I'm close to 80%. Because I mean, I really think people are real confused, and you know what? That puts me in that ballpark too. So I'm about 80%.
All right. Well, first of all, I need to look up the word verklempt. So
I don't think it's an official one. So.
Okay, we made that one up. All right, good. Jim, same question, my friend. Higher, lower by the end of the week, and give us your delta. What's your?
Well, yeah. Again, this is strictly an opinion, as it is with everybody here, so we're just taking guesses. But right now where we are is very interesting because resistance seems to be technically right above us here. So the question is do we go a little bit higher and then roll over, or is there a short squeeze on the horizon because everyone got so negative because the market collapsed in August, and then everyone got shorter out, and then obviously the market makers and the people on the other side of the trade, if you want to back in, they raise the offer. The things I think that are interesting this week are obviously the earnings. Johnson and Johnson today, Intel, all the banks, J.P. Morgan, Bank of America, Wells Fargo. So you're going to have some stuff hitting the fan there, and you got China talking about their exports in September, and some people are thinking they may have contracted 15%, and their exports also did a contraction as well, and you know. These numbers, though, that when we saw that break in the market, that was, I thought, some pretty significant technical damage. And so this rally back up, if it goes to 2100, 2150, I mean, that would be kind of a short squeeze. Other than that, you would think it would rally up into some of this resistance. And if any of these numbers disappoint from Q3, then maybe we could get a rolling over. So I would not be, a highly confident guess at this, but I would say that possibly up a little bit and then a rollover near the end of the week, unless again these numbers come out and surprise people and they squeeze the hell out of it, and the next thing you know, you could be at 2150 for all you know.
So are you unched higher or lower?
I would say lower, but confident is 50-50.
Okay, so you're 50 delta on that one. All right.
Yeah.
Got it. Corey, over to you, man.
Sure. I'm looking at the technical levels for the S&P, just pivot points. Just to name them off quickly, is S&P 2020. The Dow is about 17,200. NASDAQ 4850. That's where we are. Looking at the daily chart, we're back at the highs from the post-Fed announcement. Main thing for me is on the intraday charts, all indices included. There are negative divergences in momentum. Jason mentioned volumes of negative volume divergences. That shows up clearer on the daily chart. And, of course, negative breadth divergences and tick and advanced decline differential. So all that just shows me it's a key pivot point. It's a market that's rallied, I think, about 5 or 6 days straight up into a key target, achieved that target. Now we're seeing negative divergences, not confident we're going to get above that level. So dominant thesis, what I'm looking at, of course, this week will be, as Jason mentioned, it's earnings, really a lot of earnings. Retail sales on Wednesday, not a whole lot, just Fed speak, and that's an important thing about the expectation the Fed will not raise rates. I still hold that view in 2015. Nonetheless, from a technical standpoint, negative divergences on a lower time frame into a higher time frame resistance, that makes me short-term bearish. I'm going to go ahead and say down on Friday, barring anything unexpected in the, obviously just kind of get that disclaimer out there. But technical structure favors the downside, and I'll say 65-70% chance of confidence there.
Okay. All right. So we got a lower, we got an unch to lower, and we got a lower. I'd love to be controversial, but I'm going to stick with you guys. And quick reminder, in the top left, you can actually share your screen. So if you guys want to show us what you're looking at, you can always do that. And I probably should have told you because that's what I'm going to do. So here's where I am. In the full interest of disclosure, so I can, I think it was Jason said, hey man, I'm not going to. I don't squeeze the trigger on any trade or real capital unless, I don't drop a bomb and close my eyes and say, man, I really hope this hits somewhere it's supposed to hit. So in full interest of disclosure, I have a bear call spread on here on the S&P 500 out to Friday, the 2035, 2040. I sent that out to my subscribers at $1.05. It's at 75 cents right now. So there's $300. Also have an Apple Iron Condor we got filled on, and my Trade Monster platform is frozen and not working, so that sucks. I'm going to be with you guys. Here's we're hovering around that 50-day moving average on the S&P 500. Let me click stop plugin here. So what we're seeing is 1990-ish. And I think Jason, you hit this a couple months ago. Here's China imploding. All right, I think we can get in there. There it goes. Let me at least go over to this one. Let me pull up. There's the VIX, but here's the S&P 500. So here's China. Here's the world ending right here. Right there's China. Oh my God, the sun's not going to rise tomorrow. Well, it is, and we bounced up to 1990 right there. A little bit of a dead cat bounce, and then this tight trading band right here was us going into the Fed meeting right there. And then we had, right after the Fed meeting right here, we had what I call a yay moment. Okay, hey, yay, we're not raising interest rates. And then this boo moment was, we're not raising interest rates, meaning the Fed's creeped out about our growth in the United States, the Fed's creeped out about China, the Fed's creeped out about everything. And then this is a double bottom right here. And then the Fed, this is kind of this yay moment of, well, hell. We even saw potential QE4 rumors floating around here. This means that Grandma Yellen's going to kiss us on the head, put a Band-Aid on her boo-boo, and send us on our way and not let anything bad happen to us. So this, here's a, 1990, and you can see that we wallowed around last week with this 1990. I really don't see too much conviction in this little bit of in this break above the 50-day moving average. I gotta be honest with you, it just doesn't, after 20, 25 years of doing this, you fly the airplane for this long, you don't feel it. There's no conviction, in my opinion, above this. So I'm lower by the end of the week. And like Jason said, I don't squeeze the trigger on real capital, putting that down range unless I'm pretty damn sure. So I'm going to put a 0.95 delta on mine because I put it on that bear call spread. So that's where I am. So okay. That's where I am. So looks like we're all lower. Looks like everybody on our survey, about 52% said lower. So we'll see how we did there. So, okay, let's go to page 4 of the report, and we'll go top of the order again. Jason, let's take a look at page 4. Question number 1. Is what developing events, I know some of us hit on some of this stuff, but let's hit it again and get more tactical. What developing events, technical, fundamental, psychological, will you be watching out for trading this week, 12th through the 16th, that might have a positive or negative impact on the S&P 500 and other U.S. markets?
Hey, Matt, real fast, that's actually page 3.
Oh, sorry, page 3. I printed mine out wrong. Page 3 of the report. So where question number 1 is, page 3. And it should be on, David's got it on his screen.
Okay, so am I hearing this right? All of the moderator and all the guests are all bearish or neutral to bearish this
Take
week.
the other side of that trade, right?
Yeah, right. I'm thinking, you know what? I must have really nailed it wrong now. I mean, that sentiment indicator is not real. That's not real. It's not a real confidence builder, but that's okay. I mean, we can all make money this week if we're on the right side, right?
Correct.
Okay, when we talk about things I'm watching for the rest of the week that I think might have a positive or negative impact, I think it's the wild card. In other words, I'm not saying we're going to have a black swan event. I'm not predicting that. What I'm saying is that I think everybody has just gotten it overdone. The China thing, the Fed thing, when are we going to have something change on any of those two fronts, import-export? All the fundamentals, I think, are running behind the real issue, which is when is all this going to change? And we're at some important technical and fundamental levels for most of these markets anyway. So I think people are waiting for something that's going to be unexpected. They're looking to put a lot of confidence in that. If, I don't know, what could be an unexpected event that might make a huge difference? Something happened in Europe and dramatically affects the moving forward by the European Central Bank, or at least puts that potential change on the table. Some sort of wild card event with the International Monetary Fund. Some talks with China on some level totally break down out of nowhere. I mean, I think this week there's a real good probability that what would be a market mover would be something that causes people to go, oh my God, get me in, or oh my God, get me out. I think that we're very well secure in the current range area. Oh, by the way, I was using Dow numbers. I forgot. We're talking the S&P, so right around the 21 to 2150 area, and below. We're right up against that area now for the sell side. Buy side, of course, deeper down. And I think that we're really I think the market is ready for that. The market is ready for some sort of surprise, and I think that's going to be the driver. Now, I don't know what it's going to be, but I think everything else is already well factored in. I think everybody has got just to beat it to a dead horse now, and they're waiting for something new. That's my view.
Okay, waiting for that, essentially that other shoe to drop. Yeah, it doesn't sound. It's interesting when you say, the Black Swan event. I got to be honest with you. We've had a couple Black Swan events, in my opinion, over the past couple years that the market's just shrugged off. I mean, we wake up one day and Russia's invaded Crimea, and a couple weeks later we're shooting down an airliner.
Yeah, right.
We have,
Yeah.
we have absolute war. It's not a cold war anymore. It's actually a hot war in the Middle East. And I like to tell my traders at Topkin Options, the market only cares when it cares.
Right.
And if you care at that point, you're already too late. So David did a good job putting this question in later. We'll talk about hedging in a little bit, but I couldn't agree more, man. I mean, short of waking up and literally the sun didn't rise that day, what Black Swan event is going to knock us down here?
I think the market is really waiting for something. It seems like everything is on the table. We know where every piece of the puzzle is. What's
Correct.
the next thing that's going to break us out of this range?
Correct. Okay, Jim, what do you think, man?
Well, what I was thinking here again is, I'm looking at some of the bigger picture here with the S&P. A lot of the stocks, their 200-day moving averages are above their prices and pointing down. The technical damage that we saw in August was no joke. And we have an election year coming up, and if you know what happened in 08, 2000, 1987, 88, 1980, it's a big mess. And so have we already started that process? It's possible. Some people think that this pullback was just like 2011. It's going to get right back on the horse. And if we start taking out 2100, 2150, they're 100% right. But if they're not, this could be 2008, where it meanders in a 150-point range on the S&P, and then as we get closer to next year, they release some of the news that could make the thing have problems, which is again the Chinese numbers start really unfolding. I mean, Obama was on TV and he said, "Listen, Europe is not doing well. The emerging markets are not doing well. China's not doing well. We're doing okay." Well, if those other three factors continue to deteriorate, we're not going to be the one-eyed man in the Valley of the Blind. And the game of printing money and then buying your own debt and then printing money and then buying your own debt and squeezing everybody out so interest rates stay at zero, there's probably consequences to that, and the consequences probably coming. Obviously, deflation is a problem with it, because when we saw the real estate debt implode, what happened to real estate prices right afterwards? Obviously, they went way down.
Correct.
So this huge debt worldwide and this quantitative easing, which has permeated the entire planet now, probably has an end game to it of some size. And if I was a guessing person, the election year or the year right, in that period is a time when sometimes it hits the fan. So, you guys were saying you're doing a credit call spread up here. I mean, or whatever you're talking about. Yeah, I mean, this 2040, 2070 area, should be the best case scenario technically if it's going to roll over. And then somebody saying back Black Swan events, you could walk in here any day and see and hear something, because the liquidity must stink if they can create 1,300-point drops on an intraday basis on the Dow Jones without unemployment changing, interest rate changing, or earnings changing. So obviously the liquidity up here stinks, because the whole world has loaded up on stocks in the last, 7 years. Mm-hmm. And so if these people want to get out, I always tell people, watch how much shares are outstanding on Apple. It's almost like 6 billion shares. How much does Apple trade each day? 50 million. If 10% of the people wanted to come out of Apple, who's going to buy all that stuff?
That's exactly right.
The answer is some market maker, but he's going to buy it like he did during the crash at 90 when it was trading 130 the day before.
Yeah, or Carl Icahn, right?
Or Carl Icahn, who actually goes into things that are already discounted, like Freeport-McMoran, which went from 60 down to 8, and then he goes, okay, I'll buy 88 million shares here. Yeah, I'll get 2% dividend, and you guys will, these metals don't, disintegrate. So it's not like he's buying something that has a shelf life that's going to go away.
Correct.
And he's buying something at 85% discount off the high. So he's not exactly, I wouldn't call him a brave soul.
Well, when you can send out a tweet, move a stock that you own around, I don't know how the hell that's legal, but God bless them.
Right.
I mean, I wish I could do that. That's crazy. Yeah, it must be nice. But yeah, that Obama interview was pretty interesting. The other than that, Mrs. Lincoln, how's the play? That's type of the attitude we got going on here. Is the world's an absolute mess, but we're less of a mess, so things are great. Yeah. That makes no sense to me, but we'll leave the politics out of it. Okay, Corey, over to you, man. What technical, fundamental, psychological, rabbit's foot, whatever you want to use, are you watching this week? that might have a positive or negative impact on the S&P 500 and other markets. Did we lose you, Corey, or you might be on mute?
That's me. I'm on mute. Yeah, I like the rabbit's foot idea there. So I try to be brave and show the charts. Are you seeing the screen on the charts on the screen? Make sure we can see that.
You bet. Yeah,
okay,
we got
good.
it.
So I'm more visual than audio in terms of forecasting and trading. This is what I was mentioning in terms of the divergences. Start with this intraday S&P futures. Yes, momentum indicator making lower peaks. I'm more concerned about this, the breadth indicator also making lower highs. Was the stock market rally this last week? Breadth was strongest at the start. That's typical on the kickoff, the launch. But every sequential day, the breadth indicator, that's the differential and highs and lows, has diverged. And now we're seeing the market consolidate and have it pretty much flat to negative. That's one. Two, we're talking about this. It's the resistance 2020, looking at two doji candles, two reversal candles at that spot. That's why I'm going to be bearish at least this week. More than that, flipping over to quad market update, S&P futures, gold, current. This is crude oil, dollar index, and treasuries. Same thing. You're seeing gold and stocks rally together, but their momentum indicators are diverging. Not a good sign for continuity. Oil at this point is rolling over, so it's a risk-off money outflow. Keep your eye on this, or keep watching this commodity fall down, particularly as strongly as it has today. Given these divergences, stocks probably follow that, or at least are influenced in some way by the money flow out. Dollar has been weak this last week, as well as these have been boosted. But this positive divergence here, that's what I'm looking at in terms of intraday plays. Most markets, most risk-on markets are negatively diverging, and these risk-off or defensive markets, treasuries, and the dollar are positive diverging. So going to watch the Fed speak in terms of things beyond the chart structure. And one more quick thing to kind of not so much contradict, but it's interesting to look at. This is the breadth itself, stocks above the 50-day moving average, just an indicator on this, the right side of the chart, has been diverging well ahead of this, the crash or strong sell swing. Big thing. That's why divergences to me are critical to the style of trading that I use. It's confirmation, non-confirmation. So we had a little divergence on this breadth indicator against stocks in the S&P 500 above the 50-day, and beneath that is 200-day simple average. You see that divergence and the snap off or rally stronger higher, kickoff rally. Breadth is at this point strong. So a little bit of kind of a contradictory signal, bigger picture and short term. So bigger picture, I still think we're okay. So we go higher, bigger picture, higher frame. But if we're speaking about this Friday, going forward this week, and watch these divergences. That's what makes me short term bearish in the context of a little bit larger bullish perspective beyond this week.
Okay. All right. So you're more of a divergence guy for the week. That's
Yeah.
what you're focusing on. It's interesting because a lot of the responses that we got as I looked through a lot of them, a lot of people are focused on earnings. Obviously, that's going to be a driver of that. Let me pull mine up real quick. Good article in the Journal about profit margins. A broken clock is right twice a day. And I've said this for the past couple quarters, to my traders at least. There's nothing left on the bone. Okay, U.S. companies have been cutting, demanding more work. They've been foregoing, upgrade. People are running around. I do a lot of business consulting on the side. With check out my Windows Vista. And my 5-inch Think. Laptop here. So you can only cut so much. So I think a focus on earnings is going to be a big deal. And I think, Jim, you were alluding to this as you take a look at earnings. So profit margins. So as we go throughout the week, earnings is definitely one thing that I'm going to be looking at. I think we all agree that the absolute, potential for World War III in the Middle East, I don't think it's going to happen because we're going to declare victory, surrender, and run away. So Putin, you got to take your hat off to Putin, man. That guy, he's literally playing chess, and the president's playing checkers. We're bringing a butter knife to a gunfight, and it's embarrassing. So it's horrific what's going on and the innocent people that are getting killed. But sometimes I surf 15 years. I buried 11 of my best friends. So I have my own opinion on that, but every once in a while I got to put my Gordon Gekko hat on and just care about if this is going to happen, I'm going to make money off people's stupidity. One of the things you got to look at too is the VIX, and we'll talk about in our next question some hedging and stuff like that. But it's pretty interesting. The first time since October 2010, the VIX has fallen for 10 straight days, crashing. Remember that? Oh my God, the world's going to end because of China, from 28 to under 17, and they call it the fear index. I like to tell my traders, the VIX has what I call a resting heart rate. Okay, it reverts to its mean. Meaning, a lot of words mean there. It's not a stock, it's not, JP Morgan that goes up and to the right like this. That's not what the VIX does. I'm down here in South Florida. Oh geez, it's clear and blue skies, everything's great. Holy crap, here comes the Cat 4 hurricane. Everybody run out and go buy your hurricane insurance. All right, well, it looks like it's going to go up and hit the Carolinas. Then it goes back to what I call its resting heart rate. So I'm going to be watching the VIX this week. The fact that it's down 3% and the market, we're essentially unched on the day here. We're kind of flat. That's why I'm trying to see if I could. All right, trying to get filled on this bear call spread. So I'm going to be watching the VIX. I always keep an eye on the VIX as an options trader there. But I am, to Jim's point, looking at a lot of stuff. This is a great. I don't know who even owns this site, but this is, if you're wondering, hey, what's going on this week, try forexfactory.com and click on calendar. It gives you a great list of what's going on this week and the potential impact on the markets. The little kind of red fire thing here is a high impact as expected. Why? Well, the trade numbers out of China. What's really going on over there? And then Tuesday night, our time, we're going to get inflation numbers out of China, which we could wake up and see a big move Wednesday morning in our market. Then check out the U.S. on Wednesday before market open. Core retail sales and regular retail sales. Whenever you see the word core, ladies and gentlemen, it means X something, excluding, and in that case, it's X autos. So that could move us around. And then some PPI, the producer price index. This is what the Fed. That's one of the indicators the Fed kind of uses in their decision making. So this, before market open on Wednesday, we could see some good/bad news, and then same thing on Thursday. We're going to get some CPI numbers, weekly unemployment claims, but these two Fed indices could give us a little bit of how goes it. The Empire Fed and the Philly Fed. We got Dudley speaking, one of the Fed lieutenants out there, and then on Friday, cap rate, industrial production, and then preliminary University of Michigan consumer sentiment, and then some JOLTS jobs opening. So as opposed to last week when we didn't have that much macro data coming out, this week we actually do. But I'm going to stick with my mantra of we're in bizarro market. I tell TGO traders we're in bizarro market. What's that mean? Good news is good news. Bad news is good news, and awful news is great news, meaning the worse the news gets, the more delayed a potential Fed rate hike is going to be. But I think, as Jim was covering, the chickens are going to come home to roost one day. Wouldn't it be great if all of us could buy our own debt? I wish I could run my personal finances like the government runs theirs, because it would be phenomenal. Well, guess what? We can't, and we're going to come home to roost there. But that's what I'm going to be watching this week, all those type of events, and hopefully putting some good weekly options trades going on there. So anybody quick around the room before we go to question number 5? Any thoughts, by the ways, or anything on what you're watching for the week? Everybody good?
Yeah, I'm good.
Okay, let's go on to page 5 of the report, and we'll go top of the batting order as well as we talked about. And let me just read it so everybody can be on the same page, and it's probably on the screen there because David's got that covered. Okay, let's go to that one. Question number 4, question number 4, I'm sorry. Page 5. Question number 4. What sort of hedging or portfolio protection strategies do you implement in your trading plans, your services, your portfolios? Jason?
Well, I would like to say that I'm completely neutral in the markets. That's my hedging strategy. I don't really have a bias. What I mean by that is When I'm trading my own personal account in any of the markets that we've been discussing, I'm looking for both sides. I have a long-only account and I have a short-only account. And what I do is I put the signal that comes on one side or the other first. I manage that side independently of where a signal on the other side might come in, and I manage that side independently. So the worst thing that can happen to me is the market go nowhere for weeks, because I'll have a position on somewhere above the market looking for a short, somewhere under the market looking for a long, and neither one go anywhere, and so basically I'm stuck. If we get an event happen where the market begins to move in a direction for a period of time, the risk control on one side is taken off always at the same, and my goal is that the other side continues in that direction for a period of time of more than 72 hours. So my trading style is basically, you know, we get a buy signal, I go long. If a sell signal comes on later, I put that on too. Hopefully that'll happen with a nice gain on one side or the other first, and then we manage that so that you know, if the market crashes after that, maybe I have a break even on the long side, and the short side is what works for the end of the week. Opposite on a long position. So the worst thing for me, where that strategy doesn't work, is when you're moving sideways and you're getting signals and you're getting chopped to pieces. You know, neither side is working. So I don't actually have a bias. I try to avoid having an actual outright bias whenever possible. I mean, I've been doing it long enough where I can say, well, it looks like we're probably going to be higher, but that doesn't mean I'm looking to be a buyer only. I'll also put the short side on too.
Correct.
And attempt to get on the right side that works, because you know, you guys have seen moves where the market will move 1,000 points in 3 weeks, and that's wonderful. But almost nobody has it on for that whole distance, and they're second guessing it in between. So what I'm hoping to do is get positioned early on what appears to be a regular, typical move of several hundred points, and it may take some time for that to happen. And since we don't know which side that's going to be on, we're trying to get position on either side, both. Try to keep our losses on the losing side to the smallest amount possible, and still have some method of holding those winners longer so that the gains still overperform and still outperform the losses. So I'm basically on both sides twice all the time, mostly.
What trade are you looking at? Do you trade weekly at all, or what's your time horizon?
Yeah, time horizon is 72 hours or more. So
what's throw out what something that you're looking at for the week?
Okay, perfect example is I came in long dollar Canada Friday. I bought dollar Canada on Friday during the earlier part of the day, held it into the weekend, and we have a little bit of an open trade gain on the long side. Now, if dollar Canada were to reach certain price levels and have certain trades occur near term, a little higher up, I'd put the short side on. You know, and then what I'd be looking for is if we fell back to where we started, we'd be out break even on the long side, and basically the week would be a scratch at that point. If you know, we just get a blast higher, and 2 weeks from now we're 250 higher, then I would hope at that point that the short was off early enough that we overcame that long, or the long overcame that loss.
Correct.
I'm still holding the long, so I look for at least 72 hours to be in the trade. But I have, you know, money management dictates you don't want to give it back, so you move your stop up, then you get what happens, you get tagged out on whipsaw. You know, I mean, there's this. It's an art form. I mean, I wish there was a crystal ball that everybody had, you know, but there just isn't one, you know. So the strategy I'm using is just trying to take advantage of both sides, because one side or the other is going to go in a big way.
Well, and that's what's interesting is when you put it like that, a lot of, you know, people think, oh, geez, you know, I want to be in a hedge fund, and it's like out of the nearly 10,000 hedge funds that are out there, I've done a lot of research. I'm chief development officer of a hedge fund. It's funny because most of them aren't hedged.
Right.
So,
right. Yeah.
It's right. People are like, oh, wait a minute, you know, and it sounds like, Jason, that's what you do. The definition of a hedge fund is to make money in any market condition, whether it's going up, down, sideways. So I think you nailed it and stated it perfectly. But it's funny.
I'll tell you, you're probably more correct than a lot of listeners would like to believe about the hedge fund industry.
Correct.
And I'll tell you, I always tell people this all the time. I hope I don't offend anybody by saying this, but the typical average listener to a program of this quality and the guests on here no more than most hedge fund managers.
Correct.
So be really careful with putting your confidence into somebody who's managing a hedge fund and putting himself out there for informational purposes. You got to be really careful with that, because
Correct.
I'm amazed at how many people that you and I and the rest of the group here will run into every day that could trade circles around most hedge fund guys.
Couldn't agree more. And it's funny. I put this out to my traders. I'm like, gotta be honest with you, nobody cares more about your money than you. I don't care if it's your brother, your brother-in-law, who runs a fund. It doesn't matter. Nobody cares more about your money than you. And you're right. A lot of folks can do a hell of a lot better job than a lot of hedge fund managers. So
I hope they put the time. I hope they put the time and effort in to get that good, because
that's exactly right.
Taking control of your finances by trading your own money your own way is one of the best ways to shorten the learning curve and get to wealth.
You got it. It's not rocket surgery, as we like to say. All right, Jim, what sort of hedging or portfolio protection strategies do you implement in your trading plans?
Well, again, Option Professor doesn't actually do recommendations on specific trades. They are focusing on the education of it. So on the DVDs, we do go over hedging on one DVD for about an hour. And included in that would be your collar strategy, where you sell a call against the stock and then buy a put underneath and have some kind of a hedge going that way. Still have some upside potential, but also you have some kind of a floor underneath. The other might be the married puts, where you're just basically buying a put against the stock and having some insurance, paying out some money, and like any other insurance, you lose the premium and all fees included if you're wrong on it. And then, like any strategy, you guys, during certain environments, a hedge may not be worth the paper it's written on. For instance, if you get the VIX going from 15 to 55 in 2 days, you may have a hedge on that you thought would be able to be more effective, but in that particular environment, it could be a disaster. So it's important. That's why the education on the Option Professor DVDs, we always like to have people, get those, because you really got to understand. People walking around thinking they're in these iron condors or whatever they call them nowadays, credit spreads on either side of the market. If you get a big enough move, those things are going to still have significant risk to them.
Correct.
And so you just have to be aware of that. And, you could go through, 11 months and only one day be a problem. So it's very important. Hedging is, I think, very important, but the hedging is not some kind of a magic bullet, a silver bullet against all environments. And that's all I always temper people's enthusiasm when they say, oh, I'm in a hedge, like you guys are saying, hedge funds are a hedge. They're not hedged. They may be diversified. They may have things that will do well in a bad environment, but they're also going to have stuff that will do bad in, in a different environment.
Correct.
So the point being is as far as what I see is learn the strategies. You got the collar out there that can be effective. You've got the married puts that can be effective. You can use different contracts against each other that can be effective. But don't ever go into a hedge thing thinking that you're totally protected, because just like Katrina, everybody might have had a raincoat, everybody had an umbrella, but when that thing really hits, boom, you're going to get wet.
Yeah, it's physically impossible to be fully hedged. Otherwise, you wouldn't make any money. I mean,
right.
There's no reward without risk. I have 3 kids. What do you just wrap them in bubble wrap and put them in their bed for the rest of their life? They're going to skin their knee, so there's got to be some risk. So yeah, I think you nailed it. Okay, and Corey, how about over to you, my friend?
Well, sure. I don't really do in terms of intraday trading. That is, to me, my hedge. I don't use options. I don't use fancy strategies. I have multiple accounts. I have a couple of retirement accounts that they're just buy and hold for the most part. And the hedging, if we call it hedging, with my intraday trading, like on the S&P or Dow Mini futures, that isn't really, I don't consider that a hedge. Nonetheless, if I think like the market will fall, I'll just short that and trade intraday trades there. It doesn't really hedge necessarily, but it does give some protection. For swing accounts, another one that I do is the intermarket analysis. So it's more diversification or asset allocation. I don't consider it hedging. It's not really a word I would use for it, but if I think the stock market's flat or non-trending, I'll be in oil or be in something else or be in a different commodity using ETFs for the most part. And it's a swing account. I also swing trade individual stocks, particularly leading stocks. But the same thing, if I need to, I don't do it normally, particularly in this narrative bull market, but if the need does arise, I'd have no problem doing an SH or SDH or basically an inverse. I don't really go beyond 2x leverage, but just any type of inverse fund for a swing trade only. Again, nothing fancy new. Of course, day trading itself is just income. So I go both ways in that account depending on the market direction. So I don't call myself a hedger. I don't really hedge. Just keep diversified and keep bigger picture and do short-term trades to really just minimize the risk as much as possible.
Yeah, so it's not necessarily the definition of hedging, but if you feel the market's turning, you're going to put trades on for the market turning.
Yeah, but I don't call it hedging. It's just taking advantage of the market trend, to me at least.
Correct. You're taking shots of opportunity. Is what you're doing. Okay, awesome. That's a great way to put it. Because you don't trade options, so that's hey, market's going down. Here's one good. I'm looking at SH or STS. Yeah, exactly. Okay, here's what I do. And I do, since I do trade options, I do employ. Whoops, let's get out of that full screen. It feels like we're going back in time. So a couple things. People, in my opinion, so I do hedge. I hedge what's called the front months. We're in a front month, October, November, December, because a lot of my portfolios that we have at Top Gun Options are longer term focused. When the Jan 18 series, comes out, it has been rolling off for some, like Apple's Jan 18s came out. So we can be bullish on Apple, for example, all the way out to January of 2018. So I think by January 2018, market goes up. Apple, even if the world ends, we saw after the financial crisis in 2008, what happened? The sun rose, and here we are higher. So even if the world did end because of the Fed and quantitative easing, it ain't going to end. We go higher. But I like to, what I do, hedge the front months. But real quick, people are like, oh, well, I hedge with the VIX. Well, what are you hedging? Well, the market pulling back. Let me give you, let's have an Obama teachable moment here real quick on volatility as a hedge. Here's 2013, okay, 2013, and there's the VIX. It went from 12 to 24 in a couple weeks. Now, again, I'm no rocket surgeon, but that doubled in a couple weeks. I'll set people up for this. I'm like, okay, the volatility index doubled in a couple weeks. What was the market doing? And to a person, down, imploded, down, a random up. Well, guess what? The answer is up. The market was going up in that month. Why? This was the first Fed meeting where the Bernanke, where it was rumored that everybody and their mother, including mine, thought that Bernanke was going to start the taper. So uncertainty increased. When there's a lot of uncertainty in the market, the VIX goes up. But guess what? He was pumping 85 billion with a B dollars into the market that month. I don't care how strong you are. You can't stop $85 billion a month and that drift upward. So market up, VIX up, something's up. So be careful using the VIX as, quote, a hedge, because the VIX can go up on, quote, good news. It's more about uncertainty. So we'll be talking VIX trades here in about a month and a half going into the December Fed meeting, because why? There's going to be some uncertainty. But kind of like Corey was saying, I use, whoa, not going to be that far out in time. I use SDS occasionally as a hedge. So that it's an inverse ETF. It's the ultra short. As the market goes down, here's China killing everybody, and then it not happening. So this is upside down. This is the market upside down by 2. It's the ultra short. So what I like to do is put on what I call ejection seat trades. I never went into combat without having to sit on an ejection seat in case things go bad. So right around this 21 level, and I'll be doing a live trading session on Thursday to talk about this, I'm going to put on a tactic called a bullish double vertical, because as you can see, when this thing moves, it moves quick. When the markets go down a hell of a lot faster than they go up. So I tend to use some of these inverse ETFs. SH is one that I think Corey mentioned in passing. The ProShare is just kind of regular short, but I like SDS, and I'm going to be putting on what's called a bullish double vertical, meaning if this thing, and last comment out of me, I don't lose money on a hedge. Well, what's that mean, Wiz? Your SDS trade, lost $4,000. Well, I want to reach through the screen with a ruler and crack their knuckles like Sister Catherine. I don't lose money on a hedge. I don't sit in my kitchen every month and write a check to USAA or State Farm and go, man, I'm losing. First of all, it's on auto debit, so I didn't even think about it. But home, life, auto, when you need it, you're like, my God, thank God it was on there. Because if the market doesn't go down, let's say my hedge is out to November. If the market doesn't go down, all my longs, some front month longs, but some Jan 17, Jan 18 longs are going up. So I like to say I have a Christmas tree portfolio. If the market is having a triple-digit update, for example, if you have all green on your screen, you're wrong, in my opinion. There should be a nuclear reddish, well, I guess green, a blinding red in your portfolio, and that should be a hedge. And then when we have one of these triple-digit down days, my bright green, it looks like a submarine, launch console. The bright green is my hedge, and maybe I, take a little bit of the sting out of some of those longer-term losses and collect a little bank. So that's what I do. Take it for what it's worth. That was free, and we're good to go. All right, so guys, we're coming up on close to an hour there. That's pretty good. I want to go around the room just real quick because we had some great discussions today. I saw a lot of good comments from a lot of folks out there, and it looks like under question 4 that we did see a lot of folks protective puts, options, stops, long VIX. I hope whoever wrote long VIX got a little bit out of how I interpreted that. This week somebody's doing SH, somebody's long SDS, which is great. Deep in the money, covered calls. Jim, I loved how you talked about the collar and sometimes doing that costless collar. Let me sell an upside call to finance that downside put. So technically it's costless. But let's just go top to bottom. Let us know a little bit about your site, how we can get a hold of you, your products, your services, if anybody's interested, and then we'll throw it back over to David to wrap up.
Okay, so am I up first? Just want to double check.
Jason.
Okay,
Yes,
cool. Well, anyway, first of all, thanks for having me again this week. I love coming here and doing these and meeting new people that are like-minded, new hosts, new attendees, and speakers. So appreciate the opportunity. Thank you very much. I hope I get a chance to do this a lot more regularly too. Just a little bit about how to get a hold of me for the products and services that I offer. I'm in the middle of having a brand new website launched. Probably won't be available for another 2 weeks. That'll be the liononline.com. You can go to the old site. There's some still good stuff there, but a lot of what I'll be doing moving forward will be enhanced and changed and made real pretty for you guys to see easily what it is that I do, which is focused mainly on understanding who the loser in the market is so you can get on the other side of that trade. And that is not as simple as a buyer for every seller. And a lot of people are, I think, needlessly losing in the markets because they haven't really educated themselves to the real nature of what we're doing here every day, trading in zero-sum markets. So it's really critical, regardless of where you want to finally end up with your personal approach and the tools that you want to rely on and the approach that you want to use, it's really important to know that your profits are only going to come if somebody else has a loss. So you need to know where that person is and how they approach what they do, because part of you executing really well to get in the right side at the right time is understanding when somebody else is out there is doing it wrong. When you can see how they're showing up and doing it incorrectly, you can take the other side of your trade a lot more aggressively. So I like to focus on that psychology. And if you want to just write it down, liononline.com. Give me about another week and a half to 2 weeks, and we'll have some stuff up there for you to really shorten that learning curve, fine-tune it, and make it easy to see and do.
Awesome, Jason. Thanks for coming, man. And, yeah, looking forward to working with you and definitely having you back.
Thanks again.
You bet. Jim.
Okay, thanks a lot, Wiz. The main thing with optionprofessor.com is that they want the DVDs are there so that people understand a wide variety of strategies for a wide variety of motivations. So there's things in there like on spreads. A lot of people think they understand spreads, but they probably don't because spreads are an animal to themselves. Also covered call writing. People are not that familiar on how you're going to get called away, how dividends come in, how stock splits come in, and a lot of different things like that. They're not that familiar with all those kind of things. And then, of course, moving the options up and down, pressing them or rolling them, what that is all about, and also different strategies on writing the options, uncovered writing. The risk is not limited, and there is margin call potential and all that kind of stuff. And then there's things like the volatility measurement, where if it goes up to 55 in a day, it's going to set the options all over the place. So, there's a lot of disclosure on it. There's a lot of understanding so that the investor really has a good idea of what they're doing. And also, I made a career out of making sure people understood options, the use and the risk. And that's one of the things I'm most proud of on my 30-year plus doing this.
That's great, Jim, and literally thanks for your service, because, like we say here at Top Gun Options, man, we don't use the term financial education because the world's full of educated derelicts. People are trained to trade options. Doctors are trained. Plumbers are trained. Fighter pilots are trained. Run through some of our universities today, and you'll see what education can do. So, optionsprofessor.com. Make sure you check those guys out. So, Jim, thanks for coming. And Corey, over to you.
Sure, thanks, man. I'm at Corey@afraidtotrade.com for my email address, and I can give free trials to all the subscription services we have. It's Corey, C-O-R-E-Y, @afraidtotrade.com. Of course, the blog itself, blog.afraidtotrade.com. And it's a daily commentary. There's a lot of free material, free education, free materials for you to look and browse through. And, of course, the daily commentary, mostly for short-term swing traders and, of course, intraday traders especially. A lot of times we look at the trading day and what lessons do we learn from that, what particular setups, what particular things we can build on, build success from that, and we forecast the next trading session. And the weekly report goes beyond that, sets up your trading week. So looking at the broader flows, broader money flows, trend analysis, leading stocks, leading ETFs, and opportunities, setting up, just like we're doing here, for the week ahead. And of course, commentaries, lessons, training, coaching, business plan development, all those sort of things we go through. Lots to go through. But yeah, it's a daily commentary for all traders to experience. We also talk about psychology and have a little bit of fun along the way too, as best we can in these markets.
There you go, man. If you're not having fun, you're doing it wrong. My dad used to say, "Hey, you've never worked a day in your life, whether it was in the Navy or doing this stuff, because I could tell all you guys are very passionate about what you do, and we wouldn't be doing it if we weren't passionate about it, and we definitely want to win." Like I said, my name's Matthew Buckley. You guys can call me Wiz. You can go to topgunoptions.com/FT30. Options. That's full throttle 30 options. We just did a full throttle promo where you could get access to everything we do here at Top Gun Options. We have an offensive track where if you want to trade weekly options, for example, we have a defensive track in case you want to be a little bit more defensive, and it gives you access to one of our retirement portfolios, and then obviously our Max Afterburner where you guys can do both. I'm going to do a live trading session this Thursday, I think after the close, if you'd like to join me, and you can keep an eye on your email inbox to check that out. Other than that, I'll throw it back to David. Thanks for having me, David, and thanks for doing this again. A lot of great stuff on timing research. I love the indicator that you came up with. Like I said, I might be bringing this into my scan pattern as a potential way to trade. So, having said that, thanks for having me, David, and I'll throw it back over to you.
All right. Thanks, guys. Great show. Just want to remind everyone watching that you can go to TimingResearch.com/reports to download the current or any past reports there. Also, go to TimingResearch.com/current survey later in the week or next weekend to fill out the next survey there. If you're going to be in Vegas for the Traders Expo this week, Dave Landry is going to do a talk on Thursday, so be sure to check that out. And I just want to thank my guests, Jason Jankovsky of the Lion Online. I have it listed as .net, but be sure to check out his new site, theliononline.com. Jim Kenney of optionprofessor.com, Corey Rosenbloom of afraidtotrade.com, and Matt Buckley. Thank you for hosting this week, and Matt's going to be back next week to host, and then after that, Dave Landry will be back hosting again. So, thanks, guys.